Hello, ambitious Dennis, and welcome to another exciting episode of the Tooth and Coin podcast. I'm your host, Joseph Frugger, joined by Jonathan Van Horn. And today, we're going to talk about financial statements. Everybody's most exciting, most exhilarating topic that you could ever imagine is financial statement analysis. Jonathan, welcome to the show.
Yeah, exactly. I talk about financial statements at night after dinner with my wife with a big old glass of wine, and she just loves it. It's a big topic of conversation in our house. It's amazing. Not really. She does not listen to those things.
Everybody's topic of conversation right before bedtime is financial statement and financial statement analysis. So, Jonathan, we were talking a couple of weeks ago, and I was talking to you about a job interview that I was sitting in one time, and I was getting interviewed by a guy to take over a financial position for a company. And he asked me a question. He said, "What is your favorite financial statement and why?" So I think that'd probably be a good place to start. What are the three financial statements that are out there? Or are there two financial statements? Or are there one? Whenever we say financial statements, most of our dentists probably only typically think about one financial statement, and that would be profit and loss. But when we say, there's three main financial statements or three recognized financial statements, what are those specific financial statements and what are they called?
Yeah, so the three most common are going to be your balance sheet, profit and loss, statement of cash flow. All three of those have different names that you can call them. I've had people be confused and like, what's a profit and loss? I've only ever heard of the income statement, or what's a statement of income, or all those other things. They're the same thing. In general, it's the balance sheet. In terms of your question, to me, the financial statements, while there are three separate ones, really to get a full grasp of what's going on from a financial picture, you kind of have to be able to look at all three of those at once and be able to read what each of those are saying intertwined with a bit of education. Like, it's not something that you can just intuitively look at for most situations of, I'm looking at the balance sheet and I'm looking at the statement of cash flow and I'm looking at the P&L and trying to, all of a sudden I know everything about this business, and that just doesn't exist. One of the big problems in the dental industry is there's a lot of misconceptions around what's on those financial statements. On one side of the coin, you have people that think that they're completely worthless. And then on the other side, there are people that think that the financial statements are supposed to have every answer that exists about your practice. And neither of those answers are correct. The financial statements are great. They tell you a lot about the business, but you have to understand what's going on. You have to understand what you're looking for in each of those financials in order for you to be able to actually get any value out of those financial statements. And I think that's the reason a lot of people have misconception and some confusion around the value that bookkeeping brings and things like that. So the answer to what is my favorite financial statement, it's all of them. And if I had a choice, I'd have all of them, plus some practice management information to be able to look at in order to be able to tell what's really happening in a business. In terms of the dental field, I think the most correct answer is it depends on the industry, because there's a lot of nuances in this. Not only are there different sets of financial statements, there's different ways those financial statements can be reported. There can be an accrual basis, there can be a cash basis, the income tax basis of accounting. There's a bunch of different ways in which those same things can be reported to people. And if you don't really understand how it's being reported to you, you can make some mistakes and not have the full value of it. So what about you? Which one's your favorite one?
Yeah, it's a good question that the guy asked me at the time, and he had a right and wrong answer in his head. And his right answer was a statement of cash flows, which, as many accountants know, it's difficult to glean a picture from somebody that's not used to a cash flow statement. So anyways, I say all that to say, my favorite financial statement is the balance sheet. I think that'd be a good thing for us to talk about. We could probably spend an hour on each financial statement and trying to analyze how it all comes together. But my favorite financial statement is the balance sheet. And to me, the thing that always sticks out to me about a balance sheet is it is a measure at a specific moment in time. What is your balance in your balance sheet accounts as of today, as of the end of last month, as of the end of last year, as of mid-year? It's as a point in time, which is always one of those things. Like, let's take a snapshot of exactly where our assets sit, our liabilities sit, our owner's equity sits, like at a point in time. And to me, in my small accountant brain, it gets me a chance to figure out what are the assets minus the liabilities and what's the book value or the net worth of business, which is something that I think that a lot of people can wrap their heads around once we put it into some simple terms. So whenever we talk about assets, we talk about liabilities, we talk about owner's equity. One of the things that I always talked about whenever I was teaching class and teaching students at the college level and teaching accounting 101, they don't really understand how all of it comes into play. So I use the simple example of a home, right? So it's not specific to the business, but it'll help you understand what an asset is, what a liability is, and what is the quote equity, the owner's equity in that. We'll just use easy numbers, Jonathan. If you own a house and that house is valued at $200,000, that is the asset. $200,000 is the value of that house. If you have a mortgage on that house and the mortgage balance, the liability balance on that house is $150,000, right? So we have a $200,000 asset. We have a $150,000 liability. And that means the equity, that's something that everybody's going to be familiar with. The equity in your property in this one specific piece, in this one specific example, is $50,000. So if I wanted to look at a position of strength or weakness, I can look at a balance sheet and I can look at the balance sheet on the asset side. I can look at the liability side. And then I've got the difference. What you own minus what you owe is your worth, your net equity, your net owner's equity. That's made up a whole bunch of different complicated things. But it seemed to click with my students whenever I would say, think about owning a house and there's going to be a difference. Hopefully there's a difference. And hopefully it's a positive amount between what your property is worth, your house is worth, minus what your mortgage balance is. And that's the equity that's in the property.
Yeah, exactly. A great way to simplify the assets minus liabilities equals your owner equity, which is what you learn in accounting 101 is A minus L equals O. There's three main categories that go on the balance sheet. And I agree, the balance sheet is a great way to be able to look at the financial health of a company. It may not be able to tell you trends or net profitability or anything like that, but it can definitely show you liquidity and it can show you what type of debt ratios are coming into play. I can also show you how much money is that business actually making from a accounting point of view, not necessarily cash point of view. That's one of the limitations of these financial statements, as I said before, is that if this balance sheet's set up on the income tax basis of accounting, that owner's equity has a lot of different things that affect it. It can make those numbers look a little odd. And the reason is because that equity number rolls over every year. And so it's like a running balance. And some people can get confused on it because you can literally have a profitable, well-ran dental practice and have almost nothing on your balance sheet. Your assets could be almost, say, $100,000 and your owner's equity could be $100,000. And that practice could be a $2 million practice. One thing that's an important concept to also introduce is that value does not technically equal the equity. So to take your home at value another step further so people can understand the balance sheet, if that home skyrockets in value, let's say you bought it for 200,000 and you owed let's just say 100,000, you have 100,000 in owner's equity. If the value of that home went up to $350,000, you still only bought that thing for 200,000, but you now have equity of 250,000 because you still only owe 100,000, but the value is higher. So your basis is $200,000 minus 100,000 in liabilities equals your basis is $100,000, but your value is $150,000 above that. In the accounting world, for the income tax basis of accounting, you don't write up basis to what the value actually is. You just keep it at what your current basis is, because that's what we're trying to track on an income tax basis of accounting. So if you're looking at your balance sheet and you're like, oh no, I only got $50,000 in assets and then $150,000 in equity, you may have a business that's worth a whole lot more than that. And that's just what we call a book tax difference. If we were being very thorough and spending a lot of time on your books and you're paying us a lot of money to make those write-ups and adjustments to actual value, having a valuation done every year and having everything be written up to the value of the practice, then the balance sheet would say those things, but that can be kind of like a hidden thing inside of a balance sheet. So I think that's an important point to get across too, is that the balance sheet shows you a lot of really cool things. And also there can be things that can be a little bit misleading on it. So when we talk about the differences in equity, the equity section is the area that always gets confusing to people. So be careful around that piece. But let's talk about what you look for on a balance sheet to see a healthy dental practice, so to speak. Let's just focus on dental practices rather than talk about other industries and things like that.
Yeah, sure. So whenever you look at a balance sheet, there's typically, as Jonathan mentioned, there's three sections. There's assets, liabilities, and owner's equity. And inside of the balance sheet, most balance sheets are going to subcategorize all of those different sections. So in your asset section, you're going to have something that's called a current asset. So a current asset is something that can be converted to cash or is cash, can be converted to cash in a year or less. So this would be how much cash is in the practice checking account. Do you have a certificate of deposit? Do you have a savings account? So like these things all can be turned into cash either immediately or certainly in less than 1 year. So those are current assets. Then you've got your longer term assets and you may have some property, you may have some equipment. All of those things are going to fall into a separate section of the asset section of the balance sheet. So whenever I'm looking initially and I'm taking a quick glance, I'm going to look at current assets. And I'm also going to look at the flip side of that, which is a current liability. So when we talk about a current liability, it's the same 1 year rule. So the current liabilities are things that are due in less than 1 year. So think real simple terms like your credit card, like that's due within 30 days, right? So that's going to be due. If you're tracking your accounts payable through your balance sheet, that would be a current asset because that's going to be due in less than a year versus a long-term liability, maybe like your 10-year practice loan, that's going to be at a different section. So one of the financial metrics that a lot of banks are going to look at when they're trying to evaluate your financial strength as a practice, the line of credit, all that stuff gets called today. You can pay all of your bills times one. If you had, for example, $200,000 in the practice checking account and $100,000 in liabilities or current liabilities, then you could do that twice. So that would be a current ratio of 2 to 1. When you look at financial statements, Jonathan, I think that a lot of people look at different pieces. It's easy for me to say that if you have less cash on hand than you do in credit card debt, like that's a problem and we need to work through that. But what are some of the healthier things that you're looking for? If we just talk about current assets divided by current liabilities, or basically like if we're going to super simplify it down, cash divided by bills that are out there. What are you looking for?
Yeah, on the balance sheet specifically, another thing that is important for people to realize in terms of balance sheets is that everything is listed in the form of liquidity. So the most liquid assets are listed first in the set of the asset state. And the way the balance sheet's set up is there's the assets set, what are called just assets overall, and those are broken up into current and long-term assets and other assets. And then there's a liability section, which liability section is also supposed to be listed in order of how soon that debt is due. So the first thing that I look at the very top, which is the most liquid thing, which is cash is always going to be your most liquid thing all the time. Usually the next thing is going to be something like AR, inventory, equipment, and then other assets like intangibles and things like that will be listed. But I always look at cash. That's the first thing, because if I look at a practice and cash equals $20,000, then unless this is a startup, this practice could have some issues going further. There's a lot we can't answer yet in terms of the math concept. This is not enough information type thing. But if I'm looking at a balance sheet that has very little amount of cash, there's some liquidity issues. What happens if a machine goes down? We're going to have to take on debt. If we do have to take on additional debt in order to do that, that could exacerbate the cash problem. So the first thing I look for is cash. I look at how liquid is this business, because that can give you a lot of signs and that gives you a lot of context for what you're going to look at when you look at the other pieces of the practice. So the next thing that I'll look at is current debt, liabilities that are likely to have to come up soon. Like you said, if cash is less than credit card debt, then that's a big red flag. We've got some issues here. We've got a cash issue, because that should not be the case in most dental practices. You should not have more credit card debt than cash. From a financial theory perspective, the interest on your credit card debt will eat away at your cash faster than your cash will sit there. So the value of that cash will go down, the interest on the credit cards will go up, and you're going to have a problem that's just going to get worse before it gets better. Yes, that's a big issue for most dental practices. If I'm looking at a balance sheet just to analyze how the business is doing. And another thing that I want to really, really quickly hone in on, because we didn't preface this, we're just analyzing a practice in terms of looking at someone who has a practice and how well that practice is doing. We're not looking at this in terms of buying a practice, because what the old owner did and how good they were at saving money does not affect the new owner. This is not a specific situation that we're talking about. We're looking to buy a practice or something like that. Because to be honest with you, I don't think I even look at balance sheets whenever I'm analyzing practices to purchase. But if a client says, hey, how's my business doing? I will look at a balance sheet in that regard, because it can help me guide them better with what it is they're needing to do. Whereas if we're buying a business, I don't really care what the old owner was doing. I only care what the new owner's going to do. So it's a little bit different of a situation there. And you don't buy like the credit card debt when you buy a business. So who cares if they had $100,000 in credit card debt? It could show us something in terms of like a spending issue, but the spending on that liability would be affected in the P&L under expenses. So we'd also be already taking that into consideration when we look at the P&L, which we'll get to that in a bit. So anyway, so yes, cash, and then I'll look at short-term liabilities, then I'll look at total debt. How much do we actually have in debt in this office? Because that's a big thing. It's a big deal. You need to know how much money in debt this practice has. Because if you don't, then it's the same thing. Is this a problem that is spiraling out of control? Is this just we're investing in the practice heavily and we're using other people's money to do that? If so, that's fine. But I don't like seeing a whole lot of debt and seeing like cash and credit card debt being flip-flop. Like it shouldn't be a negative balance there, and we're taking on consistently more debt. The only way I could say it would be worth it would be is if you knew that you bought X machine would be bringing you more money. That's really the only way that'd probably be making sense. That's what I look like at on the balance sheet. I do look at equity a bit, just because I like to see if it's an S corp, how much in distributions we're taking. Equity has the net income on there, but unless it's something that our firm created for a client, I don't really even look at the owner's equity because I just assume that it's going to be wrong. Joseph and I've talked before he joined our firm. He's like, I had no idea that so many firms didn't know how to do bookkeeping. And we demand a very high quality of bookkeeping service for our company and for our clients' benefit because we believe in what's on those financials. Basically, unless it's like a trusted source for that financial statement, I don't even look at it on the equity side because most of the time it's wrong. And so my assumptions will be incorrect. Usually cash and liabilities are usually right. We've definitely seen people come in with debt and they're like, their debt is negative $800,000. You're like, oh, this is great. We're going to have some work to do on this one. So that happens. But anyway, that's really what I look for on the balance sheet as a whole. What about you? Was there anything else that you look for on the balance sheet?
One of the things I love to do with balance sheets is I love to compare them and see, most of your accounting softwares that are out there, or if you have financial statements that are generated, this is basically a book value of your practice that you can look at over time. When I'm doing a financial statement analysis or a client asks me how I'm doing and I kind of really want to dig in, I'll do a balance sheet as of the 31st of last month, and I'll compare that to the prior 3 months, or I may put it at 12/31 and compare it to the prior 3 years. And let's see over time what's going on with cash, what's going on with debt, what's going on with owner's equity. And of course, that's all also under the assumption, Jonathan, that I'm looking at a good set of books. As you and I have talked many times, we can take a look at a balance sheet a lot and say, something's not right there. There shouldn't be a negative upside down balance in an accounts payable account. That's not right. I like to look at things over time. So hopefully you've got a good set of books that you're looking at and you can look and see what's happened to cash over time. If cash goes up $50,000 a month, and equity stays the same, and we look down and it's because we've taken $50,000 out in shareholder distributions every single month. That's a good problem to have. Is cash is increasing, distributions are coming out, and we're still increasing our overall position. So I like to look at the comparative and see what's going on and what happens. If I see a big, huge decrease in cash of $25,000 in a given month, I may see, oh, look at that. They bought a $25,000 piece of equipment. Well, that makes sense, right?
Mm.
That's not money that went out the door because we spent too much money on overhead. That's a piece of equipment that hopefully is going to increase our bottom line. So that's one of my favorite ways to look at a balance sheet is to just compare it to the prior couple of periods and see. And you can look at it if you wanted to do a quarter by quarter and see what 12/31 looked like versus 9/30 versus 6/30 versus 3/31. Just see how things have progressed over time. Those are the ways that I'm looking at. And I'm also looking at the same stuff that you mentioned, which is looking at the cash position and looking at the liability position and seeing what that looks like. There's a ton of financial statement ratios that are out there. One reason that banks and financial institutions like to look at ratios is it puts everybody on the same level. So like $900,000 of debt for a dental practice is not the same as $900,000 worth of debt for a publicly traded company that's huge, like a Walmart or a Google, right? Like those are not good indicators, right? If you looked at cash in a bank account, my $100,000 is not comparable to Walmart's $100,000 in their cash account. That's why banks and a lot of financial institutions look at ratios because we can compare what's the debt to equity, what's the debt to assets, what is the current ratio, what's the quick ratio. All of these different things can basically put everybody on the same playing field to figure out what kind of cash position they are. My quick, easy one to go on is looking at that current assets divided by current liabilities and making sure that's more than one and trying to figure out what's that looking like over time. We have clients that start out and for one reason or another, they have to take out a practice loan and that practice loan doesn't cover everything that they need. They've got to look at other forms of debt, whether it's a high interest rate debt or it's a credit card they had to take out in advance on a credit card. Like we see some of these things that happen over the course of time. What you want to see is as you look back at 2018, 2019, 2020, 2021, 2022, you want to see progress in each one of these things. And if you continue to have an upside down assets versus current liabilities, like I know that we've got a problem and we've got a problem that we need to fix because we don't have any profitability. Because if we had profitability, we'd probably be able to pay down some of those debts.
Yep.
But certainly a bunch of stuff goes into all of those different pieces. You may be taking too much out in owner's draws or spending too much on CE or any of these other things. And one of the things that you mentioned early, Jonathan, was the concept of all of these financial statements work in conjunction with each other. You can't just look at a balance sheet and know everything there is to know about practice. You
Right.
can't just look at a P&L and figure out if that's a good office or not. You can't just look at a cash flow statement and say, that's everything you need to know. Because we were talking before the call, like, what if they had 5 huge cases in the month of December that jacked up their P&L, but all 5 of those cases that came through, they were super PO'd by the time that they left the office and they'll never come back again. And we're not going to have those 5 cases. So There's a ton of different things that you've got to look at in evaluating the overall health of the practice. I really like the balance sheet because it gives us a point in time. It lets us see what do we own minus what do we owe, and we want to see that number increasing over time.
Yeah, I agree. I love the fact that since it is a picture of time, you can look at two different pictures. And it's like on Facebook, I look at the pictures of my kids and when I look at them now, look at the difference that they've had and what changes and things like that, right? That's a fun thing to do to be able to see how they've changed. And the business, hopefully, when you look at the things that have changed, they've happened in a good way and they're going to be fun to look at too. So, yeah, definitely look at the balance sheet. We do that for our firm and I do that for a lot of things of comparing it period over period because like I said, the snapshot in time doesn't really tell you the whole picture. The balance sheet over time will tell you a lot more. So I agree. And just a really quick thing in terms of when you're looking at cash, a way that I try and take this concept is not only do I like to have more cash than I do short-term liabilities, I also have enough cash to equal at least 1 to 2 times what your break-even costs are going to be on a monthly basis. You would use the break-even point to basically use as a metric to take versus your cash amount to see how much cash you have to be able to sustain like kind of a rainy day fund, so to speak. So I like at least 100 to 200% of your break even point being in your business bank account with the caveat of you also need more cash than you have short term liabilities. And so, probably honestly, the best thing to do is to have your cash, net cash, which would be your total cash minus your short term liabilities. That amount should be 2 times your break even point. I think that's a very healthy amount of money to keep in there. Anything extra, then, a lot of the times in a single owner dental practice, that money gets funneled out to the owner, then gets reinvested in other places in their personal lives to be able to help with their wealth building and things like that. So let's talk about the P&L. What do you like about the P&L? What is it that, get you going in the morning when we see a really nice P&L?
Yeah, good thought. So the P&L, the profit and loss, the income statement, if we're talking nonprofit statement of activities, there's all these different fancy names for it, but it's basically like, are we running a profitable business? Is this business making any money? So I think that there's a couple of different kind of old terms that I've heard mentioned out there. So one of them is that revenue is vanity. Like, oh, look at me. I'm a $1.4 million practice.
Mhm.
Congratulations. Look at how awesome. Let me pound my chest about my $1.4 million practice. Revenue is vanity and profit is sanity. If you have a $1.4 million top line, Jonathan, but you spend 1.8 a year, like that's not a good practice. I'd much rather have a $800,000 practice that spends $400,000, right? So revenue, top line, sales, collections, whatever you want to call your top line, revenue is vanity and profit sanity. So I have a tendency to quickly scan and look at what's top line revenue look like, and quickly scan to the bottom and figure out what the bottom line income is. As I'm sure you'll probably be able to tell our listeners, like if that's just quickly where I'm going, what are some different pieces that may not tell me the whole picture? If all I do is hop straight to the bottom line in a dental practice, the vast majority of our clients and the people we work with, for the most part, are single owner practices. What's the harm in just looking at top line? Top line's 1.6. Bottom line is $10,000 or $50,000 or pick a number. What's missing in that piece of the picture that's not giving them a full picture?
So again, I'm probably going to beat this like a dead horse is that the first thing is that you got to make sure their financial statements are really accurate because if they're not, then you're going to be pounding sand to try and get any actual information off of those things. So to me, the net income or the net taxable income or whatever you want to call it, net profit, whatever it has to be set up in a format that you can understand and quickly pull out information that is discretionary in nature. One of the things that happens super commonly in dental practices is that there's a lot of discretionary expenses. Obviously, every person's situation is different, but some people, for example, take, say, a $290,000 wage. And the reason being is that that's what they think their compensation should be. Maybe it's of their production, maybe it's a percentage of revenue, maybe it's just a flat amount. But a lot of the times when they have wages of those amounts, when they're paying themselves, has something to do with the 401k that's in the practice so that they can have a profit sharing plan. When the calculations being done, they get a maximized amount being contributed from their employee and the employer deduction. And then whenever they do the profit sharing amount calculation, they usually get a pretty favorable amount going towards them if they set it up in that way. I've seen dental practices that came through, they set that up and they are literally spending $150,000 more than they have in profit on the owner's compensation. So the net income says a negative $140,000 in net income because the owner payrolled themselves 290,000.
Doesn't sound like a net loss to me.
Exactly. So that's the danger of doing that is you have to know what's discretionary and what's realistic If you're like analyzing a business and seeing how profitable is this business, it's a complicated answer because the owner should be compensated, obviously. If that person taking $290,000 in wages, top line revenues, say, I don't know, 800,000, and they only produced, I'm not saying only as in it's a bad thing, I'm saying only in terms of the conversation. They only produced, say 600,000, and they take out almost 50% of their production in wages, not to mention payroll taxes and everything that goes along with that. Then if you had an associate and they produced, 600,000 out of the 800,000 being brought in, would you pay them $290,000? Probably not. So it's discretionary, right? So like, what would be more realistic? And if you're paying them a third, you'd be paying them 200,000, and that would cut that $140,000 loss and do 60,000. So it all depends on the practice. There's a lot of different things that go into it. But if you're analyzing a practice, bar none, what I do is when I look at P&Ls, I do a head count of sellers' discretionary earnings. A lot of people use the term EBITDA in the dental field, which is not really EBITDA because most people never put back in the actual cost of someone to replace the owner. So the correct term of that is seller's discretionary earnings, which basically is you back out whatever was discretionary, which is typically the owner's wages. Is there a family member that's on payroll that is getting, $40,000, $50,000 a year to be an office manager? Are they actually there every day? Are they actually fulfilling all the roles what an office manager would do? Payroll taxes associated with that have to be backed out. Are there any travel expenses for CE that maybe be more expensive that they wouldn't normally give those same types of reimbursements to an associate to do those types of things with? Are there any types of meals and entertainment? Are there any types of health insurance? It's just for the owner. There's tons of different things that can go into that P&L that will be on the P&L. Well, it's properly being recorded, but needs to be pulled out to actually show what's happening, to be able to compare it to other benchmarks of other practices. And honestly, that's another reason why I don't really trust a whole lot of the benchmarks that are out there in the dental field, because if I don't have the full faith of every CPA's out there's financial statements, then how am I supposed to have faith in a study that benchmarks using those financials as their basis point?
Financial statements
I
are
know, I
self-reported.
know. So they're generalities, and we work with around 250 offices, and we see there are just differences in dental practices. So a P&L to me is a fantastic thing to look at, to have an understanding what's happening. But to me, you have to be financially savvy enough to calculate out that seller's discretionary earnings in order to be able to calculate what the actual profitability of this practice is from a dollars and cents perspective. Once that is done, you would then look at those different key categories, which again is another area where I find a lot of dental practices financials don't have things properly segmented inside of their financials. So you can't do that. The presentation of the P&L for dental practices is just as important as the understanding, because you and I could look at a financial statement that if it's not a really well-defined P&L, we've seen P&Ls that came through that have had 10 expenses on it. And that's all the expenses on the P&L. They have nothing else. And it's just
Wages,
like payroll taxes is added
supplies.
in that, insurance is on that. They had a consultant probably in wages. They had they probably did some recruitment that was in wages. Like it's just all in one big line item. You can't define anything out of that. So presentation is just as important as well. So what about you? What are other things you like to look at on the P&L? Because I could probably talk about this for another 2 hours. Hey, everybody, Jonathan checking in again here. Just so you know, this episode went really long. This episode is actually a 3-part episode because there's a lot for us to talk about in these episodes. So make sure you follow it up and listen to the following conversations that we'll release over the next couple of weeks. This is part 1, and we will check in with you on the rest of it going forward. Thanks. Thanks for listening to the Tooth and Coin podcast. If you enjoyed the show, we'd really appreciate it if you could leave us a 5-star review as well as a written review. Your feedback not only helps us improve, but also helps other dental professionals find our podcast and benefit from the financial insights that we share. So thanks for your support, and we'll catch you in the next episode where we'll continue to explore the business side of dentistry.